Welcome back, everybody. I thought the next most interesting stock to talk about would be a large gold miner. Why? Because, well, gold prices have absolutely skyrocketed over the last couple of years. So, what I decided to do is go with Newmont Corporation, ticker symbol NEM, which is the largest gold producer listed on the New York Stock Exchange. So what does Newmont do? Well, they mine gold and a few other things too, but mostly gold. That's what they're known for. And I'm not going to explain more than that. You know, they got mines, they dig up dirt, they pull out gold, right? So the first thing I want to talk about is actually the fact that Newmont is quite comfortably the largest gold miner in the United States. More than half of the world's tier 1 gold mines are owned or in some way invested in by Newmont, which is pretty crazy to see this compared side by side. And so this slide just shows where all of those mines are located. They have 11 managed operations and 3 that are currently in execution, mostly in North America, Latin America, and Asia Pacific. Now, what is interesting is that between their gold reserves and their gold resources, they have 300 million ounces of gold remaining, which is significantly huge considering the fact that gold prices are on an absolute tear at all-time highs. And so speaking of all-time highs, I decided to just pop up the gold chart so you can see what I'm talking about here. Ever since the end of 2022, in approximately September to October, around the start of that inflation bout that the United States and the world went through following the COVID-19 stimulus pushes, we've seen a massive run up in gold's price. It went from approximately $1,600 per troy ounce to now sitting at over $3,400 per troy ounce, which is a double in under 2 years. And what is also interesting is that many different experts believe that gold's surge in price is nowhere near complete. As the title of this says, gold price boom has legs. And basically, to summarize everything, I mean, there's this fear that the U.S. Treasury market might be losing its safe haven status, as well as the fact that there might be some major inflation potentially coming with tariffs and trade wars. And so all of those things are undermining the confidence in the U.S. dollar, which many people believe will lead to a benefit in gold becoming a more critical asset to hold as a reserve and safe haven. So that is pretty much all you need to know as background for this company. It's pretty straightforward. And so before we get into the numbers, I'd like to ask you please like the video and subscribe to my channel. It really means a lot to me, and I would love to bring more and more of these analysis videos to you. So without further ado, let's get into the numbers and see how Newmont has been doing as a company. Unsurprisingly, the entire income statement looks really nice following that massive surge in gold prices. We can see a huge change in 2023 with revenues going from about $11.8 million to just under $20 million for 2025. What I do want to point out though is that at the bottom line, free cash flow, that is quite cyclical, with highs being reached in 2020, a low at negative free cash flow in 2023, and a really nice surge again in free cash flow due to the rising gold prices. So Newmont is a cyclical company, and it's important to understand that. Obviously, it relies pretty heavily on the price of gold, but also on the price of other minerals that it mines, including copper. The margin graph shows much the same and might even show that cyclicality even better, as we see a cyclical high in 2020 of gross margins of 53%, dropping to a peak in 2023 of 30%, and has now reached a 52.79% gross margin in 2025. Newmont has done a really good job at controlling its balance sheet. They are very conservative. They have a current ratio of about 2, which means that the company has about 2 times more current assets than it has current liabilities. That's always great to see because it means the company is in a pretty stable spot financially. That statement is also backed up by the fact that they have incredible coverage on their interest right now. Their EBITDA would cover their debt payments by 47 times, and their free cash flow would currently cover debt costs by 34 times. So Newmont is in no danger of any sort of illiquidity or potential bankruptcy. Although, once again, I must point out, some years it's incredibly high, like recently at 34, and other years when free cash flow goes negative, we get negative interest coverage. Taking a look at shares outstanding, we can see that Newmont is not a very shareholder-friendly company in that respect. There is a massive leap in shares outstanding between 2023 and 2024, leading to an average compound annual growth of 9% in shares outstanding over time, which is certainly headed in the opposite direction and at a pretty fast rate. Newmont does pay a dividend, although that dividend is quite cyclical along with the company. As we can see, it hit a high of approximately $2.20 per share in 2021 and is currently sitting at about $1 per share here in 2025. And the reason for that should be obvious. In the lighter blue here, we have the free cash flow per share numbers. And so we can see in 2020, free cash flow easily covered the dividend, but in 2021, it was basically even. And then in 2022, free cash flow was only $1.77 versus a dividend of $2.05. And then obviously we had our negative free cash flow year where we had to just pay money out to shareholders from other means. Currently, the dividend coverage sits at 6.21 times, which is pretty solid, but don't expect that to last for long. And if you are a dividend investor, don't expect a stable dividend from Newmont. So now taking a look at the company versus its long-term valuations, let's start with price to sales, where Newmont is currently trading at 3.35 times its current price to sales, which is only a discount of 2.5% versus its long-term average, which means that the company is probably fairly valued. The price to earnings chart looks much uglier, and that is a reflection on the cyclicality of Newmont's earnings. Anytime we hit the bottom here, I have it labeled as 0 earnings per share, but it is actually negative. In any case, we can see the average PE is about 14.3 if we exclude the major super negative numbers that occur in negative earnings years, with a current PE of 13 times, which is, again, a discount of about 8%, so slightly undervalued, but pretty safe to say Newmont is fairly valued on this metric as well. When we take a look at the company's price to EBITDA, we see that it's currently trading at 6.71 times versus its long-term average of 9.27, which creates a much nicer looking discount of about 28%. And if we take a look at this chart, that 28% number is pretty low. It doesn't get much lower than that, really only seen lower numbers early in 2025 as well as early in 2024. Now again, my warning here, because of how cyclical it is, their EBITDA can change quite rapidly. So you may see the price to EBITDA rise sharply without seeing a rise sharp in share price. Just to keep that in mind. Now, Newmont does trade at about 9 times its price to free cash flow, leading to a premium of 20% according to this chart. Although again, I would argue because of these very, very negative numbers, that long-term 5-year average of 7.76 is probably a bit low. And so I would venture to guess that we're in a relatively fairly priced range for Newmont currently. Price to book value is much less cyclical for Newmont, as mines don't just jump and fall in value out of nowhere. So this might actually be a very solid indicator to keep in mind. And what we see here is that the company's price to book value is currently 2.08 versus its long-term average of about 2. So again, we're seeing just a slight premium of 6% in this case, telling me that if anything, Newmont is very fairly valued today. Enterprise value to EBITDA looks very, very nice, as did the price to EBITDA, with a discount of 28%. And the enterprise value to free cash flow shows a premium of about 36%, again skewed heavily negative due to that negative free cash flow year. So as with price to free cash flow, I would say this current EV to free cash flow of about 10 is probably pretty fairly valued. Newmont Corporation's dividend yield is currently 1.73%, which is significantly below its long-term average of 3%. And while the dividend is quite unpredictable and can rise or fall very sharply in a short period of time, this should give you a little bit of pause based at least on dividend yield that Newmont is somewhat overvalued. Moving on to the 10-year drawdown chart for Newmont, this really points out just how cyclical Newmont is as a company, with regular drawdowns to over 40% in 2015, hitting 30 to 35% multiple times in 2016, 2018, and nearly that far in 2021. And then this massive drawdown in 2022, which peaked all the way at 63% down in 2024. In between a lot of those falls, we did see new equity highs as well. So it is important to note that Newmont does kind of trade as a rangy stock, and with a slight inflation or float to the upside, mostly due to inflation. Taking a look at the company's earnings estimates, we can see that analysts are kind of bipolar when predicting this stock. 6 months ago is this light blue line, and that happens to be in the middle of the graph, which is not generally what we see. Then 3 months ago, we suddenly decided that Newmont was going to earn much less. And now with current estimates, Newmont is expected to earn a lot more than it had been expected to earn in the last 3 or 6 months. But there is a noticeable dip in the long-term trend, going from $4.42 for this year's earnings estimate to to $4.40 in next year's estimate, and $4.14 in the year after's estimate, meaning experts are predicting either Newmont, due to capex or lower gold prices, is going to earn less in the next couple of years. And so using those estimated earnings numbers, we can see that our implied forward PE currently is 13.1 times earnings, which is slightly above its long-term average of 14.3. So again, this chart, along with most other charts, are suggesting that Newmont is probably fairly well priced right now, but may be ever so slightly undervalued. And for the final section before our recap, we have what I call the X factors, the three numbers that can very quickly and easily tell you just how good of a deal this current stock is. So we're looking at a 5-year expected growth rate of 3.4%, which is pretty ugly, all things considered. Then we have a PEGI ratio, which is the price to earnings over its expected growth and yield, aka the total return of the stock, which sits at 2.58. If you aren't familiar with the PEGI or the later ratio, the FG ratio, basically anything below 1 is incredible. 1 to 2 is fairly solid depending on the company, and anything above 2 is generally something to shy away from. So if we look at the FG ratio, which takes the enterprise value and free cash flow of the company and compares that to its expected total return over the next 5 years, we get a number of 1.85, which is certainly better than 2.58. It's on the higher end of interesting or acceptable, but it does show that looking at Newmont from a slightly different angle does provide a little bit more value and says that the stock may be a better buy today than if we were to just look at the price to earnings. And so finally, with the recap, first and foremost, Newmont gets a safety score of 3 out of 4. It is the largest gold producer. It has a very solid balance sheet. It is probably the safest gold investment you could make, at least in American markets. But with that said, gold is a cyclical industry. Mining is a cyclical industry. So I don't believe a gold miner should generally be considered the most safe investment out there. For quality, I give Newmont a 2 out of 4. Again, this is compared more so to the overall market than just other gold miners, as this is probably the highest quality gold miner or one of the highest quality gold miners on the planet. But if you take into account the high capex that's required for mining, along with the low growth and the dependency on commodity pricing, this just isn't a company that has clear, predictable growth ahead of it. So even though its balance sheet is pristine, its assets are some of the best in the world, it's not going to compound at some ridiculous rate over 10, 20, 30, 40 years like a Microsoft, Apple, Nvidia, or other company might. Next, for value, I give it a 2 out of 4 because, as we saw, most of our different ratios said that Newmont is within a fair value range currently. It's not overpriced necessarily, it's not underpriced necessarily. And so I don't view this necessarily as a great time to buy it, but at the end of the day, there have been worse times. And finally, Newmont gets a 0 out of 3 for its X factors because a sub 4% expected growth rate is just not going to cut it, especially compared to the overall market. And looking at the PEGI and FG ratios really showed that the company does not have a good value when you compare it to its overall total return potential. So with all that said, I think Newmont is an excellent company. It's just maybe not the right time to buy it. And so it gets an overall score of 7 out of 15. This is definitely a stock that you might want to keep in mind when gold prices do eventually decide to come down. But until that point, you've probably missed the biggest run-up that the stock will have. With that said, I cannot tell the future, and a lot of smart people are saying that gold prices could continue to skyrocket, so who knows, maybe Newmont could continue to fly higher as well. None of this is financial advice, and please do keep in mind that you are in charge of your own investments, and you should make your own decisions. So with all of that, thank you so much for your view. I really appreciate everyone who made it to the end of this video. I cannot wait to see you in the next one, and please, please, please do not forget to like the video and subscribe to my channel, as I have plenty more videos coming your way. Thanks again, guys, and have a wonderful night.